to startup financing, how to raise money, valuation, and capitalization tables. So let's go over some of the initial concepts. For any company to run, you need capital. So a co-founder or a founder will use their own money to fund the initial stage of the company, but they will also use their own time. So that's sweat equity that they put in their company. But there is many ways to raise capital. One is through debt, taking loan from the bank, issuing equity, and using your positive cash flow of your product, like actually having a product that generates cash flow. So there's only those three major ways: issuing debt, issuing equity, or having revenue coming from your product. Without that, it's very hard for you to run a company. You have bills to pay, you have employees who are on your payroll, you have expenses for the software that you are using, things that you're renting, your office space. So financing is very important for any new company. So when you finance, your valuation is pre-money valuation, and you add new money either through debt, equity, or through positive cash flow. That new money that's added plus the pre-money valuation gets you the post-money valuation. So think about it, your company goes from being valued at $1 million to $2 million to $3 million. It happens by adding new money in the equation, or new capital. So capital being added either through debt, equity, or through cash flow increases your valuation, post-money valuation and pre-money valuation. Pre-money is valuation is before the new money got added. And valuation, you might think, how is valuation determined? Who can say, hey, this company is worth 2 million, 3 million, 5 million? Well, it depends on three things. When an investor is trying to invest in your company, they see if your product goal that you have for launching your product is on track. So are you going to be hitting your business goals that you are aspiring to hit? Second, they will see is whether you have the profits. Is your product profitable? Do you have a prototype that has value? And are you having real profits or just book profits? So once you have your profits and earnings, then they'll say, okay, for those earnings, I'm able to give a PE ratio of, let's say, 30 or 20, so I can multiply those earnings 30 times, and that's how I come to valuation. So valuation is an art, but it depends on these three big things. When you raise money, they're going to look at your pre-money valuation, add money, and they become investors as post-money. And when you give out equity, you are diluting your share as a founder. If you're starting a company, you give out equity to raise money, you are diluting your stake. And there are two types of valuation: bottom up and top down valuation. Bottom up, remember, in early stages there's lots of uncertainty. The go-to-market plan, the business model is not established, the strategy is not concrete. So there's lots of uncertainty when it comes to bottom-up valuation. So depending on the time and phase your company is in, there's going to be right level of due diligence needed. Stock options is another set of pool of equity that's saved to incentivize the employees to hire them, to retain them, and to keep them to build your product. Preferred stock is different than common stock. Preferred stock is a stock which has some sort of liquidity and liquidation preference. So a company who issues preferred stock, a venture capital will probably ask for preferred stocks because they're investing money into your company. So if there is a liquidation, then they are the first owners to get that money before the common stockholders. And all of these transactions of money being raised is captured in this thing called cap tables or capitalization tables. So we're going to look into that with a real example very shortly. So before that, let's look at the debt financing. So here we looked at one way is through debt financing, right? The other way is equity financing. So let's look at debt financing. A debt financing is also called as convertible notes, where you issue debt. It has a maturity, but it's very fast. Seed funding through angels is an example of convertible debt or convertible notes. It's very fast, few days to close, very few $1,000s to have legal fees to do the paperwork. It's very fast. Typically they work on the basis of discount. It says, hey, when there is due diligence and Series A funding, I have the claim to X percent, like let's say 20% discount on what the Series A financing round goes through, or they can have a lower valuation cap, saying, hey, at the minimum I'll have a lower cap of valuation on which I'm going to invest the money, because the entrepreneur can take this debt money and actually raise the value so far high that those people who are issuing debt are at a disadvantage. So the lower cap of valuation actually protects a downside, gives them an option to go with the lower cap of the valuation or the discount percentage, whichever one is lower. So there's limited due diligence done in angel investing. Typically friends and family, value-added investors are part of convertible debt. And as I said, this is a debt instrument, so it has an interest. So you can say, those people lending you money, you say, hey, I'll give you X percentage return, and there's a maturity date on which I will give you that money. Convertible notes is one sort of debt, and then SAFE is simple agreement on future equity. This is what the Y Combinator uses quite heavily. It's basically saying, hey, I have it's more like not debt, but it's more like equity, claim on future equity option. So now let's look at an example where we have two options. You can raise Series A. So now let's say you've gone through debt and now you're ready for Series A. Series A is equity funding. So you're saying, hey, I'm gonna give up a 40% stake for $4 million in Series A. And Series A, the other option, I'm going to give up 20% at $4 million. So post-money valuation for this is basically $10 million. How do we get that? We divide 4 million by 40%. So that gives us that if I take the 4 million, my valuation would be 10 million, because I'm willing to give 40% for 4, so 10 million would be 100%. And so pre-money valuation would be 10 million minus the 4 million, so that's 6 million. So before I take the money, my value of my company is 6 million. After I take the money, my value of my company is 10 million. And that would mean the debt, let's assume that I had 20% discount on my pre-money. So then 6 million, 0.8, that's a 20% discount, would be 4.8 million for post-money debt convertible. So if I have convertible notes, then they would convert at this 4.8 million. And pre-money debt would be whatever the money is invested, let's say $750,000 or 0.75 million. So you remove that from your post money, you get pre-money debt or convertible notes. So this one is lower than the 5 million cap. So let's say you had a valuation cap, you can choose where you convert. You can convert at 4 million valuation or 5 million. You would of course want to convert at 4 million valuation to find out how much price per share, how many shares you get issued to the Series A investor, and how much gets to the seed investor. Similarly, let's take an example where Series A only 20% is given for 4 million. That means the valuation is 20 million. It's like following this. And post money, the valuation is 12.8 million, and post money debt is 12.5 million. So now that is way higher than the 5 million cap. So then you will use your 5 million cap for finding out your price per share and number of shares. So you see how if the valuation goes way high, having a valuation cap helps you, but if not, it also the discount also helps you. So that's an example of seeing like which option is better for you to raise money, and how valuation caps help you to get the right number of shares and get the right number of price per share as well. So now let's look at an example, right? This is an example where we're going to look at if a company is founded and there's only one founder, and let's say they start a company, incorporate a company, and then they have 5 million shares. So this is an example of capitalization table. So we're going to look at how cap table works, and we're going to build on this table slowly. So let's say the founder says, hey, I have a brilliant technical idea, I'm going to build this company. So they start working on the prototype, and then they incorporate the company, and they issue themselves $5 million, and then they put in 50,000 of their own money because they're investing. Let's say they're hiring a contractor to do some work, they're going to put in their equity of $50,000. So now let's say they add a co-founder. They are ready to add a co-founder. So when they add a co-founder, they're like, oh, I want to give him 50%. Let's say they want to match the co-founder 50%. So then they'll give them another 5 million shares. So now the equity number of shares doubled, 10 million. And they're going to give them the same, let's say, price per share. So they now have 50-50 stake. But the total valuation investment is now $1 million. So adding a co-founder, giving them the same price per share, giving them the same number of shares, and they putting in the same amount of money, just splits the company in half. But they start realizing, hey, we need to start adding employees. So then they have options. So then they put aside 10% of their money. So they each give 5% each. So if you look it up, 50% they had, they're going to get to 45. So they're going to free up 10%. And they're going to have this option pool that they can use to hire employees. So they don't give any money. So now they have all of a sudden issued more shares that reduced their ownership percentage, but freed up equity to be given up to employees who can work for options. Now let's say they raise Series A funding with $1 a share. So remember, previously it was 1 cent a share. Now let's say they are able to find a Series A funding with $1 a share, and they're going to ask for 33%. It's like, hey, I'm going to give you, I want 33%, and I'm willing to give you for $5 million. So remember, initially it was $50,000. They're going to give them $5.4 million. And that's primarily because the share price almost 10x, right? It was 1 cent to $1, 100x, right? So same thing happened to their ownership. So now the total valuation is 1.5, $15 million, right? And they get 33%, and that means they get 5.4 million shares. You see the equity went down for the co-founders and the founder, and even the option pool reduced. So as you start adding more and more, let's say Series B happens at double the price, double the share price, and also double the valuation. So initially they gave 5.4 million, now they're getting 10.8 million, and then the share price doubled, and they want 33%. So then you see Series A percentage reduced, co-founder valuation keeps going down, but their overall valuation is going up. Now they both own 10 million in the company, right? Before it was 5 million, before 550,000. So that's a huge bump up. Even though the percentage is going down, the total ownership is going up. Now let's say they do Series C, which is like $4 per share, but they only 1.5 times 1.5 times the dollar value. They're not giving you the double, 1.5 times, but they want 33%. So then you issue them 11 million more shares. You further dilute your equity ownership, but that continues to go on. So you see how now they own 20 million. 10 million becomes 20 million because now they have the share price is increasing. So that was a good example of capitalization table. We went through venture capital funding, Series A, B, and C. Similarly, there's going to be debt funding. So when debt funding happens, there's another entries here in this cap table, and they convert once Series A funding happens. They also get equal shares that are at a discount that we saw in the previous example. So hope that's helpful. We went through a pretty simple example of cap table. We went through 2 different overviews of Series A funding with 2 different options, and we looked through convertible notes, debt instrument, and we also looked through venture funding, which is equity, and we looked through few simple initial concepts to raise the money to make your company work. Thanks.